Good afternoon and very welcome to everyone for joining Hardman & Co today at the Investor Forum. My name is Richard Angus and I'm the Head of Business Development here at Hardman & Co. I am basically going to introduce our next company, which is Custodian Property Income REIT. And we're going to listen to what Richard Shepherd-Cross, who's the investment fund manager, has to say. Custodian offers investors the opportunity to access a diverse portfolio of UK commercial real estate opportunities and blend attractive levels of income with the potential for capital growth. So without any more on my part, Richard, very nice to see you again, and I'm handing it over to you.
Thank you very much. I think the last speaker set an extraordinary pace for enthusiasm, so I'm feeling the pressure already. I'm going to talk to you about UK real estate and most particularly about Custodian Property Income REIT. And our aim is to become the REIT of choice for private and institutional investors seeking high and stable dividends from well-diversified UK commercial real estate. And I'm going to talk to you about three things. We've got 15 minutes and three things to remember: timing, income, and risk. And we'll take those as they come, starting with timing. Now, I firmly believe that we are on the cusp of a recovering market. If you ever needed fair warning that there was an opportunity in real estate, you only have to look at the amount of private equity that is active in the sector at the moment. That private equity has taken companies private: Aberdeen Property Income, Balanced Commercial Property Trust, and they have been active in the direct market as well, buying a £600 million portfolio called Charles Street Properties. And you can see the names on the right. They are all very, very active. Brookfield currently taking out Tritax Eurobox. We've also seen a significant amount of corporate M&A with mergers, UK Commercial Property REIT becoming part of Tritax Big Box, LXI and Secure Income REIT, and Columbia Threadneedle Property Trust all becoming part of London Metric. So real change. But in our bit of the market, the diversified UK portfolios, there are really only four trusts remaining: Picton, ourselves, Schroeder, and AEW. And I'm going to tell you why I think that you should consider Custodian amongst that group. In terms of timing, not only do we have private equity very active, we also have the scene well set in the direct market. Two charts here. On the left, a chart looking at rental growth, looking at the three main commercial property sectors. In the black line, industrial and logistics, the blue is offices, and the orange is retail. Now, what you can see that from the early part of this year, we've seen positive rental growth in each and every one of those sectors. Retail has recovered after probably 5+ years in the doldrums with rents falling. We've now got a really firm base from which to see rental growth. Surprisingly, offices are showing rental growth. It's by no means all offices, but the right properties in the right locations. Question: what are the right locations? They're probably core city centres, really good amenity in the immediate surroundings of those buildings, really good amenity within the buildings, and low environmental impact. Those are the sort of buildings that are strongly in demand, seeing real rental growth. And for anyone who's been following real estate over the last 10 years, they will have known that the star of the show has been industrial and logistics. And while there is still rental growth in that sector, the rate of growth has been slowing, but really positive from an occupational perspective to see rental growth coming through. The second chart that I think is pointing to an imminent recovery is looking at the equivalent yield from property. So that is the yield that takes into account future rental growth. That's the yellow line, and you can see that is forecast to fall, and as yields fall and values rise. And that is being made possible by the expectation of falling interest rates. We've now had 2 cuts in base rate. The views are split, but 3.75% base rate is not unrealistic in 12 months. Those falling rates should lead to capital growth. So when we've got capital growth and rental growth, I don't think it is rash to predict that a recovery should be around the corner. What has this meant for Custodian Property Income REIT? It's enabled us, through growing rents, to increase the dividend by 9% last year, from 5.5 to 6 pence for the year in prospect. And that dividend has grown 5% per annum since 2021. It has seen occupancy rates increase and vacancy rates fall, and our occupancy has gone from 90% to 93.5% over the last 2 years, and like-for-like rental growth for the year to March of 5.6%. And if you look at the chart in the bottom left, that is looking at the rental reversion, so the difference between what we could let all the properties for if we had them vacant and available to let today versus what they are actually let for today. And you can see that chart going back 10 years shows how rental growth has really built into real estate since 2020. And we're currently sitting at the highest rental reversion that we've had for 10 years of trading. So really strongly positive dynamics coming from the occupational market to support my view that the recovery is around the corner. This is real estate, so we need to look at real assets and see from our portfolio some of the rental growth that we've delivered in the last 12 months. In our industrial and logistics portfolio, you can see here through lease renewal, rent review, granting what I call reversionary leases, which are sort of early renewals, we've seen rental increases of anywhere between 12 and 64%. So really strong rental growth. But as I said only a couple of slides ago, it's not just about the industrial and logistics sector. We've also seen in our office portfolio really strong rental growth in Oxford, and perhaps that won't be a surprise to you. Oxford has much been in the news with the life sciences boom that is going on in that city, and we settled a new lease at a 58% rental increase over the passing rent, and in city centre Leeds, 45% increase in rent there following a refurbishment. I think the sector to watch is retail warehousing. The picture you can see there, if you've got really sharp eyes, is a Homebase, which you will have read has recently gone into administration. Happily, in advance of that, we have let that property to Wix, and that's shown a 15% rental increase. And I think that is a sector of the market where we will see further rental growth. The out-of-town retail parks, I think, is well set for some strong rental growth, and it makes up over 20% of our portfolio. And even on the high street, which, as I mentioned, it has had a difficult 5 years, strong rental growth in core high street locations. So I think that makes the case for timing. Certainly to me, that makes the case that this is now a good time to invest in real estate, particularly when we look at our own portfolio valuations, which have now been flat since December, and actually marginally up in this last quarter. And I think that tells you something about where we are in the cycle. The next thing I was going to talk about is income. And if you invest in real estate, you should be investing for income, and you should be investing for the long term, because that's what real estate does. It provides contractual income secured against the lease contracts, and we get the opportunity to increase those rents every 5 years, typically. So it's a long-term investment The compound income returns are really what drive total return from real estate. And what we aim to do with Custodian is to provide access to that diversified UK regional portfolio of smaller commercial properties in an institutional grade package. Why do we buy smaller properties? The answer is hidden in this chart, and I'll explain why. And I said at the start, there are three things to remember: timing, income, and risk. But if you only can remember one thing, then remember the next 30 seconds description of what we're looking at on this chart, because it explains why we do what we do. And what it looks at is the transaction yield of properties traded going back to 2000. It's whole market data. And the dark blue line represents the transaction yield, or the net initial yield, of properties with a lot size of under 10 million. And the light blue line, lot sizes of over 10 million. And what you'll see on the chart is that from 2000 to 2010, when all investors were happy to own large lots, small lots, but they were focused on tenant quality, building quality, and location, there was a margin, a pretty consistent margin of about 65 basis points between those small and large lots. So you could argue that's the risk premium. In truth, some of that is I can't be bothered to manage a large portfolio of small properties, and I can have a simpler portfolio of larger assets. So there's probably a bit of hassle factor in there. Let's call that 15 basis points to keep the math simple, and 50 basis points of risk premium. But since 2010, we've seen that margin open up and to maintain 150 basis point margin since 2010. And it hasn't been because there's been a change in the risk profile of those smaller regional properties. It's been a change in the buying habits of the largest share of the market. Most people pursuing relatively prime, relatively large assets, restricted supply, prices go up, yields fall, and that creates that margin. But if the risk premium is only 50 basis points, yet we're getting 150 basis point margin, then that suggests that we, with our strategy, get 100 basis points of margin for taking no additional risk. That additional margin allows us to pay a higher covered dividend, and it's that covered dividend that drives total return. And when we look back over 10 years, what this chart is showing is Custodian's share price total return to September over 10 years against the grey line, which is the benchmark, which is the FTSE EPRA REIT index. So that is basically the whole listed real estate market. And you can see that Custodian has outperformed positive 55% versus a benchmark of positive 29%. So the first thing to say is positive 55% over 10 years. I'm not that chuffed with, it should be better, but the market is at the bottom of the cycle. If you allowed compounding, if you were reinvesting dividends, that positive 55 is positive 80%. So it really shows the power of income. Why has Custodian outperformed? And the answer is we're all invested in the same market. Our lot size is slightly smaller. Over that time period, yields have compressed, yields have expanded, and no one has delivered any explicit return just through yield compression. But each and every year, we've paid a higher dividend, and that's driven that total return. Finally, and in the last couple of minutes, I'm going to talk about risk. And for real estate, risk is about tenant quality, and importantly, it's about diversification. Our portfolio is broadly spread across the country. You can see the pock-marked map on the right, and it is spread between the principal commercial property sectors. 41% in industrial and logistics, 22% in out-of-town retail, and the other numbers you can read for yourselves. Why are we focused on those two sectors in particular? Because that's where we see the most rental growth, and that is really driving returns at the moment. And the portfolio is broadly diversified by tenant. This shows the amount of rent that's paid by any one tenant in the portfolio, and I think it is unusual to be as diverse as it is, but we have no one property let to any single tenant that represents more than 1.5% of the rent roll. So very broadly diversified, therefore reduced risk portfolio. Neither are we taking tenant risk. This chart shows the Experian credit rating of the tenants in the portfolio, and it'll show you that 81% of our tenants are considered by Experian to be lower than average risk. I'm very conscious I've been speaking very quickly, but time is short, so I'm going to keep going. This chart is looking at the income return over our weighted average cost of debt. The dark blue at the bottom is our weighted average cost of debt. The light blue is the initial income return from the portfolio, with that grey blue on top, showing the reversionary potential. And you can see we're maintaining a very wide margin over the cost of debt. What does that mean? It means that debt is accretive to earnings, the earnings that support the dividends that drive the lion's share of total return. And in terms of our balance sheet position, what's the refinance risk in our portfolio? We have 4 tranches of debt. The first and smallest tranche, £20 million facility with SWIP, 3.94%, which expires in about 10 months' time. Currently paying 3.94%, and with a consideration of where the forward curve for SONIA will be when it comes to that refinance, we don't have a significant refinance risk around there, certainly less than 1% of the current rent roll to meet the additional cost of debt based on current forecasts, and they may well improve. And then we've got a large tranche of longer dated debt running out till 2028, 2032, fixed rate. So a very secure balance sheet, good quality tenants, broadly diversified. So I think we can tick the risk box. And I'm going to conclude by saying that where we are in the market at the moment, it feels to me as though if you invest for income, heads you win and tails you don't lose. So let's consider heads. Heads is interest rates fall. That's good for income-bearing assets. They should rise in value. Plus, you've locked into that high income return. Tails, interest rates stay higher for longer. Well, then the lion's share of total return is going to come from income, and therefore investing for income is still the right way to go. Thank you very much.
Thank you very much. That was fantastically comprehensive. We have a couple of questions. I'm going to start with one which involves looking at the trends in REITs again, which you mentioned to begin with, the consolidation. Just could you, is this from Liz? You've been involved in the current trend of REITs coming together to consolidate their size. What is the biggest lesson you've learned in this operation? What have you learned now that's new that you probably didn't have to think about 2 or 3 years ago?
I imagine the question is aimed at our attempt to merge with
Yes,
Aberdeen Property Investment Trust.
Yeah, I think so.
It's a really it's a very pointed question. In truth, what have we learned? We've learned that you need to have the shareholders on side, and in the end, in the API deal, it came down to 4 of their shareholders not voting for it, despite 80% by number voting in favour of the merger. And those 4 shareholders were all open-ended equity funds. They had been under huge pressure from their unit holders to return cash, and the prospect of a managed wind down and returning cash to shareholders was more than they could resist. What could we have done to sort that out? I just don't know. We did go and see them, and we told them that the quickest way to cash was to vote through the merger, and as it turns out, the portfolio was sold for less than we offered in full and final settlement, whereas what we offered was a higher price and the possibility of upside. So it's something that I think it's quite difficult to prepare for that. It felt to me like an illogical decision. But fundamentally, what I've learned is you need to make sure the shareholders are on side.
You have had a lower LTV target than most REITs for many years. Was that driven by your ability to get higher yielding assets, buying low lot sizes, or did the desire for modest gearing come first and foremost from you by how you found the best way to manage your business.
Yeah, definitely the latter. We have absolutely no problem buying as many small properties as we've ever wanted or needed. If you think about the property market, and we invest from Aberdeen down to Plymouth and from Chester across to Norwich, there are many more smaller assets than there are larger assets in that market. We set our gearing at 25% target very, very purposefully, because we were able to start with a clean sheet of paper 10 years ago, looking back as we did at the time to the global financial crisis, which was certainly looming larger in our memories then than perhaps it is today. And for those listed property businesses that went into the global financial crisis with gearing of 40% plus, very, very quickly, the bank was driving the bus and they were merely managers of the bank's assets. For those that went in with lower gearing, they maintained control of those companies throughout the process. And that's really important if you're trying to protect shareholders' interests. It was, of course, incredibly tempting when interest rates were as low as they were to increase gearing, but we were very disciplined. And given the chart I showed you with that margin over the cost of debt, there are plenty of our peers that wouldn't be able to put a chart like that up, because they have lower yielding portfolios, relatively higher cost of debt, and there is a much more squeezed margin. And I'm sure any of them in that position would be equally glad that they hadn't overgeared as well.
Thank you. We don't have much time. We've got really time for one more question, but there are more questions which we will pass on to you afterwards to deal with, if that's okay with you. This is a very current question from Colin, and it concerns, given the budget and election news recently, and you've spoken about lower interest rates coming forward, how worried are you that essentially there may be interest rates lasting at a higher level for longer? Or do you think this is just temporary newspaper?
No, I think, it partly goes to the answer to the last question around gearing. We have always been aware that near zero interest rates was an abnormal state of affairs. I am old enough to remember thinking that wouldn't it be nice if interest rates got to 5%? And it wasn't such a long time ago. So the strategy that we built was designed to work in a higher interest rate environment. So if you take our portfolio initial yield, it is 6.5%, and with reversion, that's over 7.5%, comfortably ahead of the cost of debt. So Custodian works in a higher interest rate environment. The debt remains accretive. Our absolute focus on income is unchanged, and that accretive debt will still support our fully covered dividends. So we are fine with interest rates being higher for longer. In many ways, it might create opportunities as others find it difficult to survive.
Okay, thank you very much indeed for a very comprehensive presentation. Hopefully we'll speak to you again soon. Anyway, once again, thank you very much for everybody. I hope you've all learned something from the forum, and we look forward to seeing you again soon. Thank you and goodbye.